Hi, so I've been getting a lot of questions and feedback from various clients on how to better analyze the market. So I can't give you everything in one video, but I'll give you the most basic ratio to help you gauge, or at least use a filter-like ratio to kind of weed out some of the stocks that you want to have, or some of the stocks that you just want to throw away. And it's called the price-earning ratio, or PE, or multiple. It goes by many names. PE is probably the most common. And basically, it's a simple ratio. It takes the current stock price and it divides it by the earnings per share, or EPS, on an annual basis. And when you start your research, you're going to notice two different PE ratios. You're going to notice one that says forward PE or trailing PE. Okay? And the forward PE, it's an estimate of future earnings. So we're in 2015. It's taking your 2016 estimates, coming up with your earnings per share, and then still dividing it by the earning per share is the current stock price is divided by the earnings per share. The trailing PE takes the historical number. So we're in 2015, it's going to take the 2014 earnings that have already materialized, and again, you're going to divide the current stock price by that earnings per share. So today, our example is Apple, and for Apple, their forward price earning ratio is the projected earning per share is $9.15. So you're going to take 132, because that's our current stock price. They're currently trading at 132. Divide that by the 9.15, and it gets you 14.42. So that's their forward price earning ratio. Their trailing price earning ratio, their number that they got from 2014, earnings per share is $7.35. So again, you're going to take the 132, because that's the current stock price, divided by the 7.35, and you're going to get 18 times earnings, or 18 PE. Okay, I just want to point out that the historical average market PE is roughly between 17 and 20 times earnings, right? So if you look at these two PE ratios, the trailing and the trailing and the forward, you get 18, and you also get 14.42. So roughly that is in or lower than the average PE ratio for a tech company, which is outstanding. That's why Apple remains one of the best companies out there. So I want to give you 4 points to think about when you're doing your PE analysis. First, a lower PE, people tend to think a lower PE means a discount or a valued stock. So I always use this analogy. You go into the mall, you see a pair of shoes that are $200. It's extremely expensive, but you know that the shoes are made of great quality. It's still out of your price range. You go back a week later or a month later, and you realize, hey, the shoe is now selling at $100, so that splits it in half. Now you can get a good quality shoe at a deep discount. So that's what I equate a low PE ratio to. A higher PE ratio usually means the growth expectations are much greater. So for instance, Facebook is trading around 72 times earnings. So that means that, hey, I'm expecting Facebook to continue to grow. And that's a good expectation. The problem is if Facebook doesn't continue to grow, then the stock is going to come crashing down. So you always got to kind of be leery of those higher PE ratios. You want something, I tend to use a combination of both. Again, this is just you don't use the PE for everything, it's just your entry point, but I tend to use a combination of both. Number 3, of course, losing companies, you can't generate a PE ratio. That's going to require a negative number, and no, can't do that. And number 4, you always want to compare a PE ratio with a company within a particular industry, right? You don't want to take Apple and compare their ratio with a utility company or a bank company. You want to compare it with a company like Google or Microsoft. Keep it within the industry. And last but not least, I just wanted to make this quick point. When dealing with PE ratios, I typically use a 10-year average of a particular company. So for instance, Apple, I'm going to look back 10 years to give me a really good average of where their PE ratio. It's always good to get that historical data because 1 year doesn't tell you much, right? Maybe they had a great 1 year, or maybe they had a really bad 1 year. So you want to get that historical value. And that's all I have for you. If you have any more questions, please email me, call me, Facebook me, and I'll try to get some of these videos out there to you sooner. Thanks again.